Look, I love investing in index funds so much that 90+% of my money is invested in them. But on the other hand, I also love challenging my own beliefs because I'm just a freaking weirdo like that. As uncomfortable as it feels, it's something that I'm always trying to get better at just to keep myself as open-minded as possible. Since I was doing this for myself anyways, I figured that I'd share some of my findings with you. So in this video, we're gonna go over some of the downsides of index fund investing. I know, you're probably like, Jared, there are none. Well, guess what? You're wrong, and so was I, and I'm gonna tell you about them. Hey, I'm Jared with an A, and on this channel, we talk about all things personal finance, investing, and financial independence. I know, it's crazy to think that there are any sort of downsides to index fund investing, but if we look hard enough, then we can find a downside to just about everything. Whether you realize it or not, I'm sure that we're all a little scarred from learning that the tooth fairy isn't real. What was a nice little funny story for our parents to tell us actually left a deep-seated fear of losing money in the back of all of our minds. I still wake up every single morning and look under my pillow for money. Try explaining that to a girl that you're dating who stays the night. It's a bit of an awkward conversation. Hashtag it's about darn time that we cancel the tooth fairy. All an index fund does is buy specific equities based on the type of index that it's tracking, aka copying. For example, an S&P 500 index will hold the exact same stocks that are a part of the S&P 500. The amount of each stock that makes up an S&P 500 index is based on its market capitalization. All a market cap tells you is the total dollar market value of a company. As you could probably already guess, Apple, Microsoft, Amazon, and Alphabet are the 4 largest companies based on market cap. So, they are the 4 largest companies within the S&P 500. Therefore, they are the 4 largest holdings within an S&P 500 index. When you invest in an index fund, your money gets spread among every single equity that's a part of that specific index fund. Now, how much money gets spread out among each stock is based on what the index fund is tracking. An index fund tracking the S&P 500 is of course going to hold stocks of the 500 largest publicly traded companies, but at what percentage? If you invest $100 into that index fund, then how much of it is actually going to go into each company? In the case of an S&P 500 index, it's usually going to be determined by what we talked about a minute ago, which is the market cap. In the case of VOO, which is an index fund tracking the S&P 500, it holds almost 6% in Microsoft, 5.7% in Apple, and 4.49% in Amazon. So for every $100 that you invest in VOO, $6 is going to go to Microsoft, $5.70 is going to go into Apple, and $4.49 is going to go into Amazon. I use that index fund example because it is the easiest way to understand this overall concept. When we start to get into other types of index funds that track different sectors, whatever is held within it is going to be based on the goals of that specific index fund. There's index funds for just about everything: real estate, bonds, dividends, large cap companies, small cap companies, mid cap companies. There's sector-based index funds, there's international index funds, and so many more. The first disadvantage of an index fund is that it is only going to give you average returns, or you should most likely expect it to only give you average returns. If you are someone who isn't okay with accepting an average return on their money, then this isn't the type of investment that you'd want to mess with at all. But if you are someone like me who is willing to accept average returns, then an index fund is perfect for you. These were designed in this way on purpose. Because your money is spread out among many different assets and at many different allocations, you are naturally going to benefit from the winners, but some of those gains will be offset by the losers as well. It's essentially the price that you pay for taking the passive investing route. Even though this has turned out to be one of the most successful and best ways to invest over the long run, it makes an active investor absolutely cringe just thinking about index funds. Since your money is sprinkled throughout many different companies, you're naturally going to miss out on those hot stocks that absolutely skyrocket. I was one of those people who missed out on the insane growth that we saw from Tesla stock at the end of 2019 and the beginning of 2020, since the majority of my money is invested in total stock market index funds. I missed out on 150% returns over the past 6 months and instead accepted a negative 2% return. That one hurts a little bit. but not really because I'm investing for the long term and not the short term like 6 months. There's lack of control with index funds because you don't actually get to choose exactly what is held within that index fund. If there's a handful of companies that you'd never want to own in your life, but they're a part of an index fund that you might be interested in, then you have no choice but to opt into owning a piece of each of those companies that you might absolutely hate. On the other hand, something like Tesla isn't even a part of the S&P 500 at the time of recording this video. So if you own something like VOO, that S&P 500 index fund, then you would have missed out on the insane returns that we've seen with that stock in early 2020. If you owned an index fund like my favorite one, VTI, then only 0.52% of your money was invested in Tesla stock. So for every $100 that you had invested in VTI, 52 cents of it went into Tesla. You might be thinking, well, what the heck? What if I wanted to invest more money into Tesla? The index fund, it doesn't really care about that hunch that you had about the stock because it is not in the game of stock picking. They're basically telling you to kind of kick rocks because they know better than you. I need you to do me a huge favor and ever so gently tap that thumbs up button, please. Do it with your fingers, your toes, your tongue. I don't care. Whatever you do, just make sure that it turns blue. Index funds are known for buying, holding on to investments, and not really messing around with them very much at all. They'll of course add, remove, and change the allocations, but not at the same rate as something like an actively managed mutual fund or an individual investor. That is one of the things that makes them different from actively managed mutual funds. With actively managed mutual funds, the manager will constantly buy and sell to try to cut their losses, sell what they believe is an overvalued stock, and gain an edge to beat the market. Even though they're not very successful at this, they still get an A for effort for trying. With an index fund, you can't take advantage of selling out of a stock that might be tanking right now. For example, if you owned Hertz stock and you saw it tanking or received news about their bankruptcy, you could sell out of it fairly quickly on your own. But if the index fund that you owned held Hertz stock, then you'd be stuck owning a piece of that failing stock until it was eventually removed because the index funds aren't set up to react to market conditions very quickly. By quickly, I'm talking on a day-to-day basis. You're basically stuck with those losses and expecting that the winning stocks in your index fund will offset those losses. And by the way, they usually do over the long run, but remember, this video is about the downside of index fund investing, so I'm gonna shut my mouth. With an index fund, you are investing in specific sectors with different goals, which could leave you heavily exposed to specific market conditions. If you were someone who owned a real estate index fund like VNQ at the beginning of 2020, then you're down around 20% over the past 6 months. If you owned a financial focused index fund back in when the market crashed in 08 and 09, then you probably would have been freaking the heck out. This can get pretty risky in the short term depending on how much of your portfolio is invested there and what your risk tolerance is. Because you are exposed to that specific index, it doesn't protect your downside. You have to do that on your own through investing additional money into places like bonds or other index sectors. Although index fund investing has shown to be successful over the long term, it's an extremely boring way to invest. It is literally like watching paint dry or being forced to watch 5-year-olds play soccer. All you really want to do is crack open an adult beverage just to numb that pain that you're feeling. Humans by nature want to meddle in everything because we think that we know best. So if anyone can fix a problem, then it should be me. This is not what the average person wants to hear when it comes to their hard-earned money that's invested. If this is you, then index funds probably look like the worst place to put your money because you kind of just sit there and twiddle your thumbs and kind of watch what's happening. Nothing I mentioned should stop you from wanting to invest in index funds. While these downsides are great to understand, anyone with a little bit of investing knowledge could tell you why these downsides aren't really a big deal at all. I know it's not going to stop me from continuing to invest the vast majority of my money into index funds. By the way, my favorite long-term investing platform is M1 Finance. I will have a link to check them out down in the description. If you do use that link, then it helps support myself and this channel, so thank you so much in advance. Watch my index fund investing playlist right here to your left next. Please make sure to Hulk smash that thumbs up button. Check out the description for more resources and playlists to help you out with all of your personal finance and investing needs. I'll see you in the next one, friends. Adios.